Have you ever had one of those moments? You scroll through social media, see someone showing off their stock portfolio. They made 2 months' salary in a week, and you can't resist jumping in, only to watch the stock hit the limit down the moment you buy it? You save up $100,000 in the bank, earn just $3,000 in interest a year. But the price of pork at the supermarket goes from 20 to 30. Your money quietly loses its value. Then a coworker tells you, "Hey, funds can make you rich." You follow the trend and buy the hottest one, and end up losing 20% in a year, barely hanging on to your principal. If any of that sounds familiar, then a random walk down Wall Street was written for you. It's not a get-rich-quick manual. There are no secret formulas, no hidden buy signals, no tricks to catch the next stock that hits the daily limit up. Instead, it gives you time-tested principles, proven over 40 years, that show how ordinary people can avoid 90% of investment traps without reading candlestick charts, without analyzing financial statements, and without staring at the market every single day. You can simply let your money grow, slowly, steadily, and safely. The author, Burton Malkiel, is what I'd call a two-sided expert. He's a professor of economics at Princeton University, but he's also worked on Wall Street as an investment banker and as the head of investment at an insurance company. That mix of academic insight and real-world experience makes his writing incredibly practical. No heavy math, no academic jargon, just straight talk and hard-earned wisdom. For example, he ran the numbers. If you invested $10,000 in an S&P 500 index fund back in 1969, by 2014 it would have grown to $730,000. But if you'd picked one of those hyped-up star funds during the same period, you'd end up with only about $500,000 at best. Why? Because the so-called professionals often sabotage themselves, overtrading, paying endless fees, chasing hot stocks and stepping on landmines, even recommending junk just to earn commissions. Meanwhile, the ordinary investor who simply buys and holds an index fund beats most of the experts over the long run. What's even more eye-opening is how this book shatters our biggest money myths. You think not investing is the safest choice? Back in 2013, $100 could buy 50 kilos of rice. By 2023, it only buys 30. Inflation quietly eats away about 3% of your money every year. In 10 years, that's a 30% loss of purchasing power. You think investing requires a lot of money? Malkiel says all you need to do is save $500 a month, earn an average annual return of 7%, and in 30 years, you'll have $500,000, enough for your kid's down payment on a house. You think professionals are more reliable? Statistics show that 60% of fund managers underperform the market every year. It's like hiring a fitness coach, only to find out he's gained 20 pounds himself. What's truly fascinating is how this book turns complex investing ideas into everyday common sense. It uses the story of the Dutch tulip mania to show why chasing the hottest trend always ends in loss. In the 17th century, one tulip bulb could buy a house. Then it crashed to the price of an onion. Sound familiar? It's just like the dot-com bubble in 2000 and the housing crash in 2008. The book's famous blindfolded monkey throwing darts metaphor explains why short-term stock prices are basically unpredictable. Even the experts' guesses on market moves are about as accurate as flipping a coin. It also introduces the life cycle investing method. When you're 30, you should own more stocks. When you're 60, more bonds. It's just like shoes. Young people wear sneakers, older folks wear soft slippers. What fits you best is what matters most. Whether you're living paycheck to paycheck, a fresh grad just starting your career, or a retired grandpa, you'll find your place in this book. If you're risk-averse, it shows you how to set up an index fund with regular contributions. You don't even have to think about it, and you'll still beat inflation. If you've lost money before, it helps you review what went wrong, so you won't repeat the same buy high, sell low mistakes. And if you're planning for the future, it tells you exactly how much to save each month, so you can retire comfortably at 60, more reliable than any Social Security calculator. Next, let's start from the most fundamental question. How much is a stock really worth? And why do speculative bubbles keep repeating throughout history? Once you understand that, you'll realize that most of the traps that make us lose money are already written deep in human nature. To understand why the stock market goes up and down, you first need to figure out one core question. What actually determines a stock's value? For centuries, investors have been divided into two opposing camps, like two rival martial arts sects, one focusing on the sword, the other on inner power. Each believing their own way is the ultimate truth. And every major speculative bubble in history was born out of the clash between these two schools of thought. Let's start with the first one, the firm foundation theory. It argues that a stock's value can be calculated. The core idea is intrinsic value. Every asset has an objectively fair price. Just like the value of a house depends on its rent, location, materials, and cost, the value of a stock depends on how much profit the company can make in the future. The man who proposed this idea, John Williams, wrote The Theory of Investment Value in 1938 and gave us a formula. The intrinsic value of a stock equals the present value of all its future dividends. In simple terms, you take the money a company will pay its shareholders in the future, discount it back to the present using a certain interest rate, and that total gives you what the stock is worth today. For example, if a stock will pay a $10 dividend next year and $11 the year after, and the interest rate is 5%, its fair value would be 10 divided by 1 plus 5%, plus 11 divided by 1 plus 5% squared, which is about $19. Sounds solid, right? Warren Buffett's teacher, Benjamin Graham, was a loyal believer in this theory. He preached buying bargains, buy when the market price is below intrinsic value, and sell when it's above. But here's the problem. Who can accurately predict future dividends? A company might earn $100 million this year and lose $500 million next year. Growth rates and interest rates are just guesses. It's like trying to value a house when you don't know how much rent it'll fetch or for how many years. Your calculated intrinsic value ends up being a castle in the air. That brings us to the second theory, the castle in the air theory. It says stock prices depend not on math, but on belief. In other words, prices aren't calculated, they're created by people's expectations. This idea came from the economist John Maynard Keynes, the same guy who said digging holes and filling them back up could stimulate the economy. Keynes compared investing in stocks to a newspaper beauty contest. Judges are shown 100 photos and asked to pick 6 faces they think will be the most popular. A smart player doesn't choose who they think is prettiest. They try to guess who others will find prettiest. The stock market works the same way. It doesn't matter if you think a stock is worth $100. What matters is whether someone else is willing to pay $150. That's the essence of the greater fool theory. As long as there's a bigger fool willing to buy from you, you can still make money no matter how ridiculous the price looks. That's why some companies that are losing money still see their stock prices skyrocket. Think about the internet boom of 2000. People believed those companies would make huge profits someday, so they paid big money for the story itself. But every story eventually ends. The bigger the bubble, the harder it bursts. Burton Malkiel took it one step further. He argued that short-term stock prices are random and impossible to predict. They move like a drunk man staggering down the street. His next step left or right has nothing to do with the last. Why? Because the market is too smart. Every bit of information, earnings, policies, rumors, gets priced in almost instantly. If a company announces it just discovered a new drug, its stock price will soar immediately. By the time you read the news and decide to buy, the rally's already over. That's why both chart-reading technicians and number-crunching fundamentalists struggle to consistently predict short-term price moves. That doesn't mean prices are completely random. In the long run, stock prices still follow a company's earnings growth, just like the drunk man eventually staggers home. But in the short term, market sentiment, liquidity, even the weather can push prices around, like the drunk man getting blown sideways by the wind. If theory is the Tao, then speculation throughout history is the extreme form of its technique. From 17th century tulips to 21st century real estate, humans keep repeating the same madness. We all know something isn't worth that much, but we still convince ourselves. This time, it's different. Take the Dutch tulip mania, for example. In the 1630s, a nation of rational merchants went completely insane over tulip bulbs. At first, prices of rare varieties rose gradually, kind of like today's limited edition sneakers. But by 1636, even the most common bulbs were selling for sky-high prices. One bulb called Semper Augustus could be traded for 12 cows, 4 pigs, 2 tons of butter, 1,000 pounds of cheese, plus a bed and a full set of clothes. Roughly 30 years of a craftsman's income. And it got even crazier. People started buying tulip call options, paying just 20% up front to reserve a bulb, then selling it to someone else at a higher price later. It's like putting down $20,000 on a $100,000 apartment, watching it rise to $200,000, and flipping it for an easy $80,000 profit. But when people suddenly started selling, the bubble burst in an instant. By 1637, tulip bulbs had crashed back down to the price of onions. Countless people lost everything. Some even wiped out their entire life savings. That was a classic castle in the air collapsing. People didn't buy tulips because they wanted flowers. They bought them because they believed someone else would pay more. Malkiel said that's no different from any later market bubble. The only thing that changes is the asset. Next came the South Sea bubble in Britain. In 1720, the South Sea Company staged a much more sophisticated scam. It claimed to have an exclusive monopoly on trade with South America and promised massive profits. The stock price soared from £100 to £1,000. Even Isaac Newton couldn't resist. In the end, he lost a fortune and famously sighed, "I can calculate the motions of heavenly bodies, but not the madness of men." The trick behind the bubble was simple: a good story and insider trading. Executives hyped up imaginary gold mines in South America while secretly dumping their own shares. Politicians took bribes to promote the company. Even the king bought in. How could ordinary people possibly stay out? Things got even crazier. A bunch of other bubble companies popped up, promising nonsense like turning lead into silver from miles away, or inventing a perpetual motion machine. One company even printed in its prospectus, "Engaged in a business of great advantage, but no one knows what it is," and people still rushed to buy. When the truth came out that the South Sea Company hadn't done a single trade in South America, the stock crashed 90%. Families went bankrupt overnight. The British Parliament later passed the Bubble Act, banning companies from issuing shares, a ban that lasted more than 100 years. But history just put on a new costume. By the 20th century, the game was the same, only the labels changed. In the 1960s, during the electronics craze, any company with electronics in its name could double its stock price, even if it sold shoelaces. There was one called Space Tone, basically a door-to-door record seller. After renaming itself, its stock jumped from $2 to $14. Then came the biotech bubble of the 1980s. On IPO day, some gene therapy companies saw their stocks triple. Analysts said, "Forget the PE ratio. It's all about the research pipeline." But most of those firms didn't even have a real product. Eventually, prices dropped 75%. And then, the dot-com bubble of 2000. The Nasdaq shot up 100% in a single year, then plunged 80%, wiping out $8 trillion in market value. China wasn't immune either. When the Nasdaq hit 5,048 points, Chinese A-shares also went wild. A canned food company jumped 300% in 2 months just because it announced it was going online. A gaming stock hit 25 consecutive limit-ups in 33 days before getting suspended for financial fraud. All these bubbles had the same DNA. People weren't chasing profits. They were chasing stories. Just like the tulip's rarity, the South Sea Company's monopoly, and the dot-com promise of eyeballs and clicks, they were all excuses to justify castles in the air. Then came the U.S. housing bubble of 2008. In the early 2000s, banks were giving loans to people with no income, no job, and no assets, because everyone believed housing prices would only go up. Those loans were bundled into mortgage-backed securities and sold to investors all over the world. Credit rating agencies even stamped them 3A. But when prices stopped rising and borrowers began defaulting, the entire chain collapsed. Lehman Brothers went bankrupt, and the global economy fell into recession. This time, even the supposedly rational banks and rating agencies became part of the greater fool game. They all assumed someone else would take the loss, until they realized they were the last fools standing. Looking back at all these manias, you start to see a pattern. Every bubble begins with logic, accelerates with greed, and ends with panic. At first, there's always a valid reason. Tulips were rare, the internet could change the world, real estate hedges inflation. But once the crowd piles in, reason goes out the window. For regular investors, remember these 3 simple rules. They'll help you avoid 90% of traps. First, never believe this time is different. Every bubble in history came with fancy words. New economy, new tech, new paradigm. But human nature never changes. Second, beware of companies with no real profits. If all they have is a story and no earnings, don't touch it. It's like a building with no foundation. It's bound to collapse. Third, don't buy what you don't understand. Whether it's tulips.com stocks or complex financial products. If you don't get it, stay away. You'll never earn beyond your level of understanding. These stories and theories remind us, stock value isn't just about cold numbers. It's a reflection of human psychology and emotion. In the next part, we'll see that even so-called professionals, analysts and fund managers, can't escape these patterns. Their technical analysis and fundamental analysis often fail in irrational markets. And that's why Malkiel says, instead of chasing the pros, ordinary people are better off keeping it simple. Buy index funds and don't overtrade. On Wall Street, professionals are often portrayed as elite insiders who hold the secret codes to wealth. Analysts in suits stare at their screens drawing candlestick charts, and fund managers talk confidently on TV about their stock-picking secrets. But Burton Malkiel, after decades of research, proved a painful truth. Most of these professionals actually perform worse than simple index funds that just sit there doing nothing. So where did they go wrong? Let's start with technical analysis. The core belief of technical analysts is that price movements follow patterns, that the past can predict the future. They draw head and shoulders, triangles, and calculate support and resistance levels, claiming they can spot buy and sell signals. But in reality, it's more like self-deception, searching for patterns with a magnifying glass that don't really exist. First, the logic behind technical analysis doesn't hold up. It's based on the assumption that trends continue, that what's rising will keep rising, and what's falling will keep falling. But the stock market is driven by information. Any piece of news, a company beating earnings expectations or a sudden policy change, gets reflected in prices instantly. Past trends don't determine future ones, just like yesterday's sunshine doesn't mean it won't rain today. Malkiel once ran a famous experiment. He had his students flip coins. Heads meant the stock went up, tails meant it went down. When they plotted the results, the chart looked almost identical to a real stock market chart, complete with head and shoulders, breakouts, and resistance levels. That shows these so-called patterns are probably nothing more than the illusion of random movement. Second, many of those fancy-looking technical systems are total traps. Take a simple filter rule. Buy when the stock rises 5% from its low, sell when it falls 5%. Backtesting shows that after trading fees, you'd earn less than just buying and holding. Or look at the Dow theory, which says a breakout above a previous high is a buy signal, and a drop below a low is a sell signal. But the market often fakes you out. It breaks above resistance one day, then crashes the next, trapping everyone who chased the move. Then there's volume analysis, the idea that rising prices with higher trading volume signal strength. But data shows there's no real correlation between trading volume and future prices. It's like a supermarket. A crowd doesn't mean the products are better. So why do technical analysts still survive? Because they always have a post hoc explanation. If the stock rises, they'll say, "See, I predicted that breakout." If it falls, they'll say, "That was a bear trap." Just like a fortune teller saying, "You'll face bad luck this year." And if nothing happens, they'll claim, "That's because I fixed it for you." As Malkiel joked, The precision of technical analysis depends entirely on how convincing you sound. Now let's talk about fundamental analysis. Fundamental analysts seem more sophisticated. They calculate P/E ratios, check profit margins, visit factories, and claim they can find undervalued stocks. But the problem is, no one can accurately predict future earnings, and analysts are often influenced, or even controlled, by conflicts of interest. First, forecasting is basically impossible. Analysts can't even guess next year's earnings correctly. A company's profits are influenced by economic cycles, competition, and government policy. It's like trying to predict the exact temperature a year from today. A Harvard study found that analysts' one-year earnings forecasts had an average error of 30%, and five-year forecasts were even worse. For example, in 2000, analysts predicted Cisco would grow 25% annually. Instead, its earnings dropped by 90%. What's even more ironic is that analysts love to chase momentum. When a company beats expectations, they immediately raise the target price. When it misses, they rush to cut it. It's just like sports fans. When their team wins, they shout, "We're the champions," and when it loses, they yell, "They suck," totally lacking independence or objectivity. Second, there's a massive conflict of interest. Many analysts are really salespeople, not researchers. On Wall Street, an unspoken rule is that analysts' pay is tied to the bank's investment banking deals. If a brokerage firm wants to underwrite a company's IPO, the analyst has to hype that company's stock. During the dot-com bubble in 2000, Merrill Lynch analyst Henry Blodgett privately called a certain internet stock junk in his emails, but publicly recommended it as a strong buy, because that company was an investment banking client. This kind of "you scratch my back, I'll scratch yours" system turned research reports into advertisements. Studies show that analysts covering investment banking clients give ratings about 30% higher than for other stocks, and those same stocks usually perform worse afterward. 3. The fatal flaw of fundamental analysis. The market is always smarter than you. Even if an analyst calculates that a stock is worth $100, but it's currently selling for $80, that doesn't guarantee profit, because the market probably already knows something you don't. A low price might hide invisible risks, like undisclosed debt. It's like finding a bottle of wine that seems too cheap, only to realize later it's already expired. Now let's talk about why most actively managed funds underperform the index. People assume that paying a high fee for a professional fund manager must lead to better returns, but the numbers don't lie. Over the past 20 years, more than 60% of active funds have failed to beat the Standard & Poor's 500 index. And the ones that perform best one year are often the ones that crash hardest later. The first reason is high fees. Active funds charge management fees, usually 1 to 2%, plus trading commissions and taxes. Altogether, these can eat up around 3% of your returns every year. Index funds, on the other hand, usually cost only about 0.1 to 0.5%. For example, if both funds make 10% a year, after fees the active fund nets only 7%, while the index fund keeps 9.5%. After 30 years, 100,000 yuan in the active fund grows to 860,000, while the same amount in an index fund becomes 1.52 million, a difference big enough to buy a house. The second reason is overtrading. Fund managers like to prove their worth by constantly buying and selling stocks. Their turnover rate often exceeds 100%, meaning they replace their entire portfolio every year. But research shows the higher the turnover, the lower the return. It's like moving houses too often. You pay fees, waste time, and miss out on long-term appreciation. The third reason is star funds fade fast. Every year there's a fund that ranks number 1, but fewer than 10% stay in the top half the following year. It's like flipping a coin. Someone might call heads 10 times in a row this year, but that doesn't mean they'll do it again next year. The top tech fund in 2000 later crashed 80% because it was overloaded with internet stocks. The top bond fund in 2008 fell to the bottom in 2009 due to a bad market call. Fund size is also the enemy of performance. When a fund performs well, more investors pile in. As the fund grows, the manager struggles to find enough undervalued stocks, and large purchases push prices up. Take Peter Lynch's Magellan Fund, for example. It grew from $20 million to $11.4 billion, and then its performance declined. It's like a small fishing boat turning into an aircraft carrier. It can't move freely anymore. So where exactly do the professionals lose? The author says, it's not because they're incompetent. It's because the game itself is unfair. Many analysts and fund managers are brilliant and highly educated, but they're trapped by structural disadvantages. On one hand, the market is too efficient. Any new information is instantly priced in. Finding a bargain is harder than winning the lottery. On the other hand, incentives are misaligned. Fund managers earn fees based on assets under management, not performance. So they prefer to chase popular stocks rather than take creative risks. And of course, human nature is hard to overcome. They too fall for greed, fear, and overconfidence, just like ordinary investors. At this point, you might ask, so is it even possible to win? Malkiel says yes, but not by beating the market, rather by understanding it. New academic theories, like diversification to reduce risk and using beta to measure risk versus return, can actually help regular investors avoid the traps professionals fall into. In the next part, we'll see how these new investing methods can empower everyday people to take control of their financial future. The reason professionals keep failing isn't because they're not smart enough. It's because the market itself is just too tricky. But that doesn't mean ordinary people are helpless. Over the past few decades, academia has developed new investing tools, like self-defense weapons for everyday investors. You don't need to understand complicated formulas. If you just grasp the core logic, you can avoid the biggest traps and even outperform the pros. Let's start with modern portfolio theory, or simply, don't put all your eggs in one basket. The magic of diversification is that it can reduce risk without cutting returns. In the 1950s, economist Harry Markowitz came up with a revolutionary idea. Owning different types of assets can lower your risk without sacrificing your gains. For example, if you hold both stocks and bonds, when the stock market crashes, bonds usually go up and help offset your losses. When stocks rise, their higher returns lift your entire portfolio. During the Great Depression of 1929, U.S. stocks fell 80%, but government bonds actually went up 10%. In the 2008 financial crisis, U.S. stocks fell 37%, while gold went up 5%. If you had split your money, half in stocks, half in bonds, your losses would have been cut in half compared to being all in stocks. That's the power of diversification. It doesn't eliminate every risk. During a global crisis, most assets can still fall, but it dramatically softens the blow of any single collapse. So how do you diversify effectively? The answer is, across industries, across countries, and across asset classes. Industry-wise, don't just buy tech stocks. Mix in consumer goods or healthcare, which tend to hold up better in downturns. In 2022, tech stocks dropped 30%, but energy stocks rose 50%. That mix helps balance things out. Country-wise, when the U.S. market tanks, emerging markets might rise. For example, when the U.S. .com bubble burst in 2000, Brazil's stock market went up 140%. And cross-asset diversification means mixing offensive and defensive assets. Stocks for higher returns, bonds for stability, and gold for inflation protection. Burton Malkiel calculated that a portfolio including global stocks, bonds, and real estate had about the same long-term annual return as an all-stock portfolio, but with only half the volatility. For most people, sleeping well matters more than making a little extra. Now let's talk about risk and return. Does higher return always mean higher risk? The Capital Asset Pricing Model, or CAPM, introduced the concept of the beta value. A beta of 1 means the stock moves in sync with the market. If the market goes up 10%, so does the stock. A beta above 1 means it's more volatile. Say beta equals 2. When the market rises 10%, it jumps 20. But if the market drops 10, it falls 20. A beta below 1 means less volatility. Utility stocks, for example, often have betas around 0.5. In theory, the higher the beta, the higher the return should be. But in real life, that doesn't always hold up. From 1963 to 1990, high beta stocks actually underperformed low beta ones. The reason's simple: volatility isn't the only kind of risk. There are hidden ones too, like bankruptcy risk or sudden policy changes, and beta just can't capture those. Economists Eugene Fama and Kenneth French found that besides the overall market, there are two other key factors that affect returns. One is company size. Smaller firms tend to have higher long-term returns than big ones, though they're more volatile. The other is value. Stocks with low price-to-earnings or price-to-book ratios, the so-called value stocks, tend to outperform high-valuation growth stocks. The takeaway for everyday investors is simple: don't chase hot trends. A mix of small-cap and undervalued stocks, or index funds that track them, can beat the broader market over time. But remember, this isn't free money. You're trading specific risks for potential rewards. Small companies can go bust, and value stocks can stay undervalued for years. Now let's talk about behavioral finance. Even professionals make mistakes, and ordinary people are even more easily swayed by emotions. Behavioral finance is like a psychological counselor for investors. It helps you avoid the traps you set for yourself. There are 3 common mistakes most people make. The first one is overconfidence, thinking you're smarter than everyone else and trading too frequently. Studies show that the more frequently people trade, the lower their returns tend to be. It's like playing cards. You keep thinking you can win, but the more you play, the more you lose. The second is loss aversion. You can't bear to sell when your stocks drop, but you rush to sell when they rise. For example, when a stock falls 30%, you keep hoping it'll bounce back before selling, but you end up digging yourself into a deeper hole. When it rises 10%, you panic and cash out too early, missing the bigger rally ahead. The third mistake is herd behavior, buying whatever everyone else is buying. Back in 2007, people were piling into real estate funds. In 2015, everyone was chasing growth stocks on the Chi-Next board, and in the end, most of them became the ones left holding the bag. So, how do you fight these human weaknesses? First, check the market less often. Watching prices every day amplifies your emotions. Once a month is plenty. Then, set clear stop loss and take profit points. For example, sell if it drops 15%, or take half your profits if it rises 50%. Let rules replace emotional decisions. The simplest approach is to invest regularly in an index fund. No matter if the market goes up or down, buy the same amount each month. That way, you automatically buy more when prices are low and less when prices are high, and you avoid the temptation to time the market. In recent years, smart beta strategies have become popular. They claim to outperform the market by focusing on certain factors, like low volatility or high dividend stocks. But here's the truth. At its core, smart beta is just factor tilting. For example, a low volatility strategy only buys stable stocks. Over the long run, its returns might be similar to the overall market, but with smaller fluctuations. That's not beating the market. It's just trading one kind of risk for another. And remember, what worked in the past doesn't guarantee it'll work in the future. From 2000 to 2010, value investing outperformed, but from 2010 to 2020, it lagged behind. Why? Because too many investors piled in, driving prices up until there was no more profit left to make. Lastly, smart beta funds usually charge higher fees and are more complicated to manage. For ordinary investors, simple is often smarter than smart. The goal of these new strategies isn't to beat the market. It's to help you understand it better and make fewer mistakes. Diversifying your investments reduces risk. Behavioral finance helps you control your impulses. Index funds protect you from the traps professionals fall into. Next, we'll move on to the most practical part, the action plan. How should you adjust your asset allocation as you age? How can you use retirement accounts to save on taxes? And how do you pick the right index funds for yourself? Master these basics and you'll have a simple but powerful way to grow your wealth steadily. After reading the first 3 parts, you might ask, okay, I get the theory, but what should I actually do? Malkiel gives a step-by-step foolproof action plan. You don't need to understand financial jargon. You don't need to watch the market every day. Just follow the steps and your wealth will grow steadily. The core logic is simple. First, build a solid foundation with savings. Then, use tools to minimize taxes and invest in index funds. Finally, adjust your strategy based on your age. Step 1. Saving. Time is your most powerful weapon. Start as early as possible, even if it's just $500 a month. Malkiel emphasizes again and again that the biggest risk in investing isn't market volatility, it's procrastination. If you start saving $1,000 a month at age 25 with a 7% annual return, you'll have nearly $2 million by 60. If you start at 35, you'll only have around $800,000, a difference of $1.2 million, all because you missed 10 years of compounding magic. The essence of compound interest is earning interest on your interest. Your gains this year become your principal next year. It's like rolling a snowball, small at first, but it grows bigger and faster over time. Einstein once called compound interest the eighth wonder of the world. For ordinary people, it's the fairest wealth-building tool that exists. You don't need a huge amount of capital. You just need enough time. Don't save whatever's left at the end of the month. Instead, save 10 to 20% of your income right after you get paid. You can set up automatic transfers from your paycheck into your investment account and spend what's left. This trick keeps you from accidentally spending all your money without realizing it. For example, if you earn $10,000 a month, put $2,000 into an index fund and live on the remaining $8,000. At first, it might feel tight, but after 3 months, you'll get used to it. Human spending habits are flexible. Skip a few lattes or avoid buying things you don't really need, and you'll be fine. Step 2. Build a safety net, cash reserves and insurance, to prevent financial ruin overnight. Keep an emergency fund covering 3 to 6 months of living expenses. This money is not for investing. It should always be accessible for emergencies like job loss or illness. Store it in a money market fund, a savings account, or short-term certificates of deposit. The returns aren't high, but the money is safe and flexible. Why not keep less? Because if you suddenly lose your job and have no cash, you might be forced to sell your investments when the market is down, locking in losses. That's a fatal mistake for investors. As for insurance, only buy protection, not investment-linked products. The essential types are critical illness insurance, to cover major medical costs without selling your assets. Term life insurance, a must-have if you're the family breadwinner, ensuring your loved ones are financially supported if something happens to you. Health and accident insurance, to cover what public health care doesn't, usually just a few $100s a year. And here's a big warning. Stay away from combo policies that claim to offer both protection and investment returns, like whole life or universal life insurance. They sound attractive, but in reality, they charge high premiums, provide low coverage, and come with management fees and commissions. In the end, you might earn less than from a regular bank deposit. Malkiel reminds us, the purpose of insurance is to transfer risk, not to make money. Don't mix the two. Step 3. Tax efficiency. Let the government help you save more. Taxes are the silent killer of wealth. For example, if you make $10,000 from a fund and pay 20% capital gains tax, you only keep $8,000. But if you invest through a tax-advantaged account, that $10,000 can keep compounding tax-free, and over time, the difference could be tens or even hundreds of thousands. The first way is to use tax-deferred retirement accounts. Malkiel mentions the American 401k plan, which is similar to company pension plans in other countries. Part of your salary is automatically contributed to this account before taxes, and you don't pay income tax until you withdraw in retirement. Even better, many employers match your contributions. If you put in 3%, they add another 3%. That's free money. The second option is an individual retirement account, or IRA. You can contribute a set amount each year. Your contributions are tax-deductible, and your gains grow tax-free until you withdraw at retirement. The key idea is to let your money compound longer in a tax-free environment. For example, if you invest $100,000 at 7% annual growth, In 20 years, it becomes $400,000 tax-free. If it's taxed, you might end up with only $300,000. That missing $100,000? It's the compounding power lost to taxes. The third strategy is long-term investing. Trade less, hold longer. Frequent trading of stocks or funds leads to short-term gains, which are often taxed at rates as high as 30%. But if you hold for more than a year, your gains are considered long-term, and the tax rate may drop to 10 or 20%. For instance, if you make $50,000 and sell after 6 months, you owe 30%, $15,000 in taxes. Hold for 2 years instead, and you might pay only 15%, $7,500. That's $7,500 more in your pocket, just because you didn't hit the sell button too soon. Step 4. Build your asset allocation like stacking blocks, and adjust it as you age. People at different ages have very different levels of risk tolerance. In your 20s, you can handle a stock market crash. You've got decades to recover. But in your 60s, when retirement is near, you can't afford to take that kind of risk. Malkiel's life cycle investing strategy is basically about adjusting your portfolio as you grow older, just like rearranging building blocks. In your 30s and 40s, you should stay aggressive, focusing mainly on stocks and not worrying too much about volatility. A good allocation would be 70 to 80% in stocks, such as index funds tracking the CSI 300 or CSI 500, and 20 to 30% in bonds, like government bonds or high-grade corporate bonds. The logic here is simple. At this stage, your income is growing and you can handle more risk. Even if the stock market drops by 50%, as long as you don't sell, chances are high that it'll recover over the next 10 years, and you'll probably end up making even more. From your 50s to 60s, shift to a balanced approach. Cut your stock exposure in half and increase your bond holdings. A solid mix would be 50% stocks, 40% bonds, and 10% cash. The reasoning is that you're only about 10 years away from retirement. You can't afford to see your portfolio fall by half again. Bonds give you steady income, and cash helps you cover short-term expenses. After 60, go into defensive mode. Your goal is to protect your principal and maintain stable returns. The allocation could be 20 to 30% in stocks, mainly high-dividend blue-chip companies, 60 to 70% in bonds, and 10% in cash or gold. The idea is that after retirement, you'll live off your investment income, so the priority is not losing money. Stocks help you fight inflation, while bonds provide stable cash flow. Step 5. Choosing the right tools. Index funds are your best partner. Ordinary investors don't need to pick individual stocks. Buying index funds is enough. They track the overall market. For example, the CSI 300 represents a basket of major stocks. They have low costs, usually between 0.1% and 0.5%, and over time, they outperform about 80% of actively managed funds. So how do you pick a good index fund? There are 3 things to look at. First, low fees. The lower the management and custody fees, the better, ideally below 0.5%. Saving just 1% a year in fees can double your total returns over 30 years. Second, low tracking error. The closer the fund's performance matches its benchmark index, the better. An error smaller than 0.3% means the manager isn't messing around. Third, large fund size. At least $200 million in assets. If a fund is too small, it might get liquidated. The best strategy for busy or lazy investors is dollar cost averaging. Invest a fixed amount on a fixed date every month, say $1,000. No matter whether the market rises or falls, you'll buy more shares when prices drop and fewer when they rise, automatically buying low and selling high. For example, if an index fund costs $10 per share in January and you invest $1,000, you get 100 shares. In February, the price drops to $5. You invest another 1,000 and get 200 shares. Your average cost becomes $6.67 per share, much cheaper than buying all at once at $10. This entire guide isn't about getting rich quick. It's about avoiding 90% of the traps, saving early, building an emergency fund, using insurance and tax advantages wisely, adjusting your allocation with age, and sticking to index funds. If you can do these things consistently, you'll already be ahead of 80% of investors. After finishing this book, you'll notice a fascinating paradox. The most powerful skill in the stock market isn't perfect prediction or constant trading. It's simply making fewer mistakes. Over 40 years of market observation, Malkiel proved that successful investing isn't about beating the market, but about understanding how it works and not letting greed or fear take control. For ordinary investors, the key is to hold on to a few simple principles and avoid falling into traps that guarantee loss. The heart of avoiding mistakes is acknowledging your own limits. The market, by nature, is unpredictable. Even the smartest economists can't guess what'll happen tomorrow. Even the best fund managers can't escape the cycles of boom and bust. Once you accept this, you're already ahead. Most people think they're the exception. Then they end up losing everything by chasing rallies and panic selling. It's like driving. Beginners try to overtake every car, while experienced drivers only focus on not crashing. Investing works the same way. You need to protect your capital so you can live long enough to see compounding work its magic. Now let's go through the specific principles of avoiding mistakes. First, don't touch what you don't understand. Cryptocurrencies, complex derivatives, or niche overseas markets may look tempting, but if you don't even understand the rules, it's like crossing a highway with your eyes closed. Malkiel says, if an investment needs more than one page to explain, skip it. Second, stop chasing perfect timing. No one buys at the bottom and sells at the top. It's better to be roughly right than precisely wrong. If you're planning to buy an index fund, don't wait for the perfect low. Just start investing regularly. Your long-term results won't differ much. And if you bought at a high point, don't panic sell. Use time to average down your cost. In the short run, the market is a voting machine. In the long run, it's a weighing machine. Quality assets always return to their fair value. Third, never put all your eggs in one basket. Diversification is the only free lunch in finance. A simple mix of 50% index funds, 30% bonds, and 20% cash works well. In a bear market, bonds and cash cushion your losses. In a bull market, stocks drive your gains. Remember, don't go all in just because one type of asset looks good right now. That's like wearing only short sleeves because it's hot in summer. Winter always comes. Fourth, don't ignore small costs. Fees, taxes, and management charges may look tiny, but over decades they become massive. Two funds might both earn 10% a year, but one charges 1%, the other only 0.1%. After 30 years, that 1% difference can cost you $700,000 on a $100,000 investment. So always check the fees first and save whenever possible. In the end, investing is a reflection of your attitude toward life. Malkiel says at the end of the book, investing isn't about becoming a millionaire. It's about living with peace of mind. The true masters of investing aren't glued to stock charts every day. They're the ones who weave investing into their everyday lives. They know when to add more, say, when the market drops over 30%. They know when to take some out, like when they actually need the money. And most importantly, they know when to do nothing, when the market is volatile. For most people, the best investing state is simple. Buy an index fund, set up an automatic investment plan, then go live your life. Work, spend time with your family, and check your portfolio occasionally, just to make sure you're not losing too much. Years later, you'll realize your wealth has quietly built itself. The stock market is like a forest. Some people spend their lives trying to find the tallest tree and get lost. Others focus on growing their own tree and end up with a forest. The essence of investing is finding certainty in uncertainty, knowing the level of risk you can bear, committing to long-term patience, and having the discipline not to react to short-term noise. Once you master that, you'll understand. Financial freedom isn't the goal, it's just the byproduct of not making mistakes. And when you stop obsessing over beating the market rewards you in return. Congratulations, you've just finished another book.